And we're now in Washington talking with Char. Char, welcome to Allworth Money Matters.
So I have a question. It's about stocks. My husband and I, we have about $600,000 in 401k pre-tax savings. We have 30% in cash, 50% in index funds, about 10% in bond index, and then 10% in various stocks. Also, we buy stocks, and if it's a win, we sell it and take a quick win. And if it's a loss, we keep it forever and ever. So I was wondering
just to remind you of the poor decision, or what? Why do you keep it forever?
Let's just say it's not my choice.
Got it. Okay.
We are close to retirement, and I think me and my husband, we have to merge our risk levels. I think he thinks that we're going to get a win, so we keep it, that it'll turn around. And it's occurred to me the other day, that means I think we have too much in cash. We're not making money. And that if we sell when we make money and keep the losers, then we have short-term wins and long-term losses, which means we're going to lose a lot more, right?
How much money are we talking about in the
$600,000?
No, that's in the IRA, and the brokerage account is where you're. The money that you're buying the money that you're buying these stocks in, are you doing it inside the IRA?
Yes, I have one at Fidelity that's active with my employment, and then another one at E-Trade. It's pre-tax.
Okay, and none of this. So when you're buying these and selling these stocks, none of it's in a regular brokerage account. It's all in an IRA or a 401k. Is that correct?
Almost true.
Okay.
We have about $75,000 in a Fidelity, and that one's not pre-tax. And
okay.
That one's in, I think I got VFIAX.
All right, you're not trading that one.
You're not trading that one. Okay.
You're not triggering taxes for yourself. So, I mean, let's start with the first thing, cash. You mentioned too much in cash. I think cash is fantastic to put money that you're going to need within a short period of time.
What is a short period of time, Scott?
If I plan on let's say you plan on buying a vacation home next year, or you're a couple years off from retirement, you plan on moving somewhere and you want to have some flexibility to buy something before you sell your existing, or whatever it might be, you're going to take one big trip around I don't care what it is. If it's money that you need within 5 years, cash is fantastic.
That
doesn't fluctuate in value. You know it's there. When you call up the bank to say time to transfer the funds, you know what the value is going to be. Great for short term. Terrible for long-term investments because it just doesn't earn that much. And if you consider stocks historically, if you go back the last 100 years, they've done about 6 to 7 percentage points above that of the rate of inflation. So let's say inflation's 3%, they've averaged 10%. Historically, that's the kind of return you get, as opposed to cash has usually been about 0.5 percentage point above inflation. So particularly in 401k investments, having a large allocation to cash, I mean, unless you're planning on yanking those dollars out and spending them, it just doesn't make a lot of sense.
It makes no sense.
It makes you feel good because your portfolio doesn't swing as much, but
it doesn't. It isn't based on really what your timelines are,
nor what your retirement needs and objectives are.
Right. It's just kind of it's worse than stagnating, right? Well, I think his thought is if he has cash and he sees a big deal, he can buy it.
Okay.
Well, so let's talk about the individual stocks for a moment. Okay. So you own index funds, right? In your portfolio.
Yeah, we have a lot of index funds.
And the reason index funds have become popular, one, they're low cost, but two, even more so, it's most professional managers can't outperform the market.
Especially the broad
market. Even with
market.
Their teams of analysts doing all that research, the vast majority do worse than if they just said, you know what, let's just forget all this. Let's just buy the index. So on the one hand, you believe that. That's why you own index funds. But for some reason, your husband thinks he's got some skill that surpasses Wall Street to be able to trade stocks. Now, people invest for a lot of different reasons. Some of it is a bit of a sport, a bit of gamble, a bit of all those things. And I think it's fine if it's kept to a small percentage of one's portfolio. And for example, if you and so obviously you and your husband don't see eye to eye on this. My guess is there's other parts of your marriage you don't always see eye to eye. There's parts of my marriage we don't always see eye to eye. But we have a conversation. We say, look, how do we make this work for both of us, even though we don't fully agree? So maybe the right thing is that 10% never goes more than 10%. He can trade how he wants. Maybe it's 5%. I don't know. But
I would have a tendency to actually segregate those dollars into the brokerage account, leave the 401k money
carve it out at 10% special IRA.
A special IRA that allow him to trade in it. And by the way, the idea that you never sell any losers, the thesis is just foul. It makes no sense at all, because the question you should be asking.
And you'll sell any of the tomorrow's leaders if you sell the.
Yeah, but the question you should be asking: would I buy this stock today if it was available to me? And if you say yes, I would buy this stock today if it was available to me, then you continue to hold it, and you do that with both your winners and your losers. Not sell your winners and keep your losers, but that's a completely different. He'll need to call us directly to get that sort of input.
That sounds like great advice. Thank you.
All right, Char.
I do have a few other questions. I don't know if you have time.
Yep.
Sure.
Oh, okay. So I'm a Boeing employee.
We for years we were on the radio, live on the radio, where we had to live by the radio clock, right? So whenever the commercials were coming, the breaks, we had to get through the calls quickly to get the break. We've moved past that. We're still broadcast on terrestrial radio, but we designed this program now more as a podcast, and we schedule our calls. So it gives us time to have a little more in-depth conversations, which we enjoy. So fire away at your next question. And you wouldn't have, by the way, our screener wouldn't have scheduled you if they thought you were a bad call. So.
Okay. So I'm a Boeing employee, and I have a pension. I'm lucky because the trend is to not do pension.
Yep.
But I do have a pension, and we're not sure, my spouse and I, what options. We have a lot of options to take. And the big one is, just take a lump sum. He looked, you can put it into a pre-tax.
Yeah, you can roll it into an IRA. And what's the size of that lump sum?
It should be around $300,000.
Okay, so $300,000.
Mm-hmm. Or we can take, a monthly chunk.
And so the number we'd like to compare to is the full joint and survivor. So in order to compare apples to apples, you take the pension lump sum and you compare what would happen if you took a pension and if you were to predecease your husband, he would receive exactly the same pension. And so the Boeing pension probably has 7 or 8 different options that you can choose from.
Yeah.
The one we're interested in is the one that actually is the same level, whether you're living or dead, that goes to your husband. What is that number?
Yeah. 1 second. I'm going to get that because I have it right here.
Okay.
Pension. Yep. It's 100% survivor.
That's right.
Okay. Yeah. And so that is around, if I retire when I want, it's about $1,800.
Okay. And how old will you be when you retire?
65.
Okay.
So a couple things on this.
How old are you now?
62, and he is 65 now.
Well, so does he work at Boeing as well?
No.
Okay. So we're going to give you an answer today, but it's not going to be the right answer for 3 years from now. And the reason is that pension lump sum moves up and down based upon interest rates and your life expectancy. Essentially what happens is the pension sets aside a lump sum of monies for you, And they use this internal interest rate in order to determine that lump sum of money. And then the idea being is that if it's 7%, the internal interest rate, that based on a normal life expectancy, that pot of money should be empty at the remainder of your expected life.
Knowing that some people are going to die prematurely and some are going to live much longer.
And so what happens is the lower that interest rate, the higher the lump sum. The higher that interest rate, the lower the lump sum. But you need to do the calculation at that particular date and time.
And then there's a couple ways to look at it. One is to say, what rate of return do I need to earn to provide that same income while maintaining my principal?
And
that's how most people like to look at it.
And we'll refer to that as the hurdle rate.
The other one is to say, well, apples to apples, what rate of return would I need to provide that income to the remainder of my normal life expectancy and then have it go to zero by that point? So it's a lower rate of return you'd need to.
So the things that you take into common.
But most people don't like seeing their account balance going down.
That's right. So you want to calculate it based on what you would hurdle rate, or what you would expect that you would return in a well-balanced portfolio.
The older you are, the harder it is to justify a lump sum. Just because it's not that big, right? I mean, if you're retiring at age 80, your life expectancy might be 6 years. It's not going to be very, very much money.
So the answer to your question is call us back in 3 years. And by the way,
we have probably thousands of clients that have taken lump sum.
So if you were calling today and saying, I'm leaving today, assuming everything else is equal, that you have a normal life expectancy, and that comes into play, your husband has a normal life expectancy, we would tell you today we'd be more inclined to take the pension. And I would increase the allocation in that 401k up to 75% equities.
Oh, you would take pension lump sum, not pension.
No, I'd take the monthly pension. I'd take the monthly pension if it was today, and I'd increase the 401k allocation more to equities. That's as little as we know about you now. Now, if you have millions of dollars elsewhere, that might change our opinion, because you're able to tolerate a little bit more risk in the up and down.
Okay.
But you're not going to get an answer. In fact, you could worry about it if you want, but you're not going to get an answer until you're ready to retire. And I would plan on taking the pension. And if interest rates are really low at the time you go to retire, maybe you'll take the lump sum.